Hello everyone. Welcome to my channel. Today we are going to talk about a very important topic in corporate finance: dividend decisions and dividend theories. Have you ever wondered why some companies pay dividends regularly while others don't pay at all? Do dividends really increase a company's value, or are they just a way to keep investors happy? Well, different financial theories try to answer these questions, and today we are going to explore them one by one. By the end of this video, you will have a solid understanding of how dividend policies work and why companies make different choices. So, let's get started. Dividend Irrelevance Theory, Modigliani and Miller. Our first theory is the Dividend Irrelevance Theory, proposed by Modigliani and Miller in 1961. According to this theory, dividends do not affect a company's value at all. Sounds strange, right? But here's what they argue. Whether a company pays dividends or reinvests its earnings, the total value of the firm remains the same. This is because investors can create their own dividends by selling shares. So, in a perfect market, dividend policy doesn't matter. Main assumptions: investors are always rational, and financial markets are perfect. All investors have equal access to information. No transaction costs or taxes exist. But do we really live in a perfect market? Probably not. That's why many experts challenge this theory. Let's look at the next one. Bird-in-hand theory, Myron Gordon. Now, let's talk about the bird-in-hand theory developed by Myron Gordon. Have you heard the saying, "a bird in the hand is worth two in the bush"? This theory suggests that investors prefer cash dividends now rather than waiting for future capital gains. Why? Because dividends are certain, while future stock prices are uncertain. So, according to this theory, when companies pay more dividends, their stock value increases because investors see them as safer investments. Main assumptions: the company only uses retained earnings for investment, no external financing. Growth rate and cost of equity remain constant. This theory directly contradicts the irrelevance theory, but it makes sense, right? Many investors want stability and prefer getting cash now, rather than hoping for stock price appreciation. Tax preference theory. Next, we have the tax preference theory. Did you know that in most countries, capital gains are taxed at a lower rate than dividends? And investors only pay taxes on capital gains when they sell their shares. So, according to this theory, investors actually prefer companies that reinvest their earnings rather than paying dividends because this helps them avoid higher taxes. This explains why some companies, like tech giants, don't pay dividends and instead focus on long-term growth. Signaling effect, signaling theory. Now let's talk about the signaling effect. Have you ever noticed that when a company increases its dividend, its stock price often goes up? That's because dividends send a signal to investors. If a company increases dividends, investors see it as a sign of strong financial health. If a company cuts dividends, investors think it's in trouble. So, companies use dividends not just to reward investors, but also to signal their financial strength. Clientele effect. Let's talk about the clientele effect. Not all investors are the same. Some prefer dividends while others prefer capital gains. For example, retirees usually prefer high dividend stocks because they need a steady income. Younger investors might prefer companies that reinvest their earnings to maximize future growth. So, companies try to attract the right type of investors by adjusting their dividend policies. Residual dividend model. Now, what if a company only pays dividends when there's money left after all investments? That's exactly what the residual dividend model suggests. In this model, a company first funds its investment projects. If there's money left, it distributes dividends. If not, no dividends. This is why some companies have unstable dividend policies. Their priority is growth, not regular dividend payments. Pecking order theory. Finally, let's talk about the pecking order theory. This theory says that companies follow a strict order when financing their operations. First, they use internal funds, retained earnings. Second, they take on debt. Only as a last resort, they issue new shares. This means that when companies rely more on internal funds, they have less money left for dividends. Conclusion. So, what have we learned today? Some theories say dividends are irrelevant, while others argue they increase firm value. Some focus on taxes, while others look at investor preferences. In reality, there is no one-size-fits-all answer. Different companies adopt different dividend policies based on their goals and financial situations. If you found this video useful, don't forget to like, share, and subscribe.